There's a storm brewing that could leave millions of Americans unable to afford long-term care expenses, and perhaps it could be a perfect storm which could really accelerate the increasing cost of long-term care. A recent Morningstar column warns retirees will be facing increasing pressure from aging populations, inflation, and technological advancements, suggesting that costs could severely outpace inflation. And that could really erode retirement savings. So let's take a quick look at what Morningstar has to say in this column. So they say that we're at a collision point, which I would agree when it comes to long-term care. And there is an inadequate supply to meet the increasing demand for long-term care services that will further increase costs. So Medicare covers medical expenses, but it doesn't pay for in-home care, such as bathing, dressing, using the toilet, etc. And we don't have a comprehensive long-term care plan in place, and that really has left millions of our nation's seniors and even older homeowners at risk. So there is a shortage of long-term care labor. Morningstar points out that experts fear that the labor shortage will be even worsened by the crackdown on illegal immigration. They say that immigrants make up 28% of the long-term care workforce. They don't say if they're documented or undocumented, but if they're undocumented, yes, they may not be coming to work soon. And also the supply of care will be impacted if Congress approves cut to Medicaid funding. They also say that Medicaid funding could be impacted if the House bill, which was sent to the Senate, is passed. And if they're referring to the big, beautiful bill, the Senate just approved it and they kicked it back down to the House. We'll see what develops. By the time you watch this, that may have been resolved. So what are some of the options that Morningstar proposes for dealing with this long-term care crisis? And they have 5 of them. They list 6, but there's 5. First is to spend down to qualify for Medicaid. That is whereas one is going to be diluting their assets, liquidating them over time, and hopefully they can qualify for the needs-based Medicaid, or Medi-Cal as it's called here in California. Also, there are fewer long-term care insurers in the marketplace, which really is having an impact. But life insurance companies have responded by offering what we'd call a hybrid life insurance plan, which combines a life insurance policy with a long-term care rider. And those have become increasingly popular. And so that is where you can take part of the death benefit and utilize it for long-term care. Of course, as long as the policyholder meets the obligations and the qualifications for that. Next is self-funding. Now, this is going to be for those that have the cash on hand to do so. That would be your mass affluent individuals. And if they can do that, that would be perhaps a lot less expensive than paying for long-term care insurance if they have health conditions, which would drive up their premiums. Next, they mention health savings accounts, which I'm a little surprised because while I agree that health savings accounts are a very useful tool and can be a tax advantage strategy for stashing money away for deductibles, et cetera, and copays or other care that's not covered, they do not, even with the maximum contribution limits, allow for one to save enough for serious long-term care expenses, but nevertheless, they list it here. Then there's guaranteed income sources. They mentioned Social Security, of course, which is one, or a pension defined benefit plan. And you could also have someone purchase an annuity that is deferred for a number of years and then can pay out after a certain period of time has passed. And then lastly, home equity. Yes, they say it's an often overlooked strategy as a financial resource. And, kudos for Morningstar at least mentioning this. Now, one thing you could do with your home equity is to downsize and relocate to a lower cost area. But for some, that's just not possible nor desirable. So if that isn't, then a reverse mortgage could be an option. They do mention that the loans can be very complex to many. And also, they say the risk of foreclosure, I don't understand how they say this, that the risk of foreclosure is somehow heightened with a reverse mortgage. Well, newsflash, borrowers can default on property tax and insurance payments. Guess what? Yeah, on a traditional mortgage. Oh, and by the way, if an older homeowner has a home that's completely paid off, free and clear of a mortgage, then they can be foreclosed on as well for not being up to date on their property taxes. They would have to be in serious arrears. I should clarify that, but they could have a property lien sale or a tax sale. So the reverse mortgage is not unique for the risk of foreclosure, but again, at least they mention that these are potential solutions. So home equity, guaranteed income sources, health savings accounts. I just don't see how that really works. Self-funding, and spending down to qualify for Medicaid. So keep in mind when you're meeting with potential reverse mortgage borrowers and you're doing your financial fact finding to ask them if they do have any plan in place to pay for long-term care expenses, because that will have a very significant impact on their retirement security. So HUD's making some big moves, in fact, across the Potomac River. That is the latest news we got in the last week of June when it comes to the national headquarters of the Department of Housing and Urban Development. A very unique building, and you can see some of the futuristic architecture. But HUD is going to be leaving that facility, and that is the Weaver building, and relocating to new headquarters that they feel would be much safer. Now, when I say much safer, what does that mean? Well, let's take a look at one of the videos they put together. So without going through the entire video, let's just talk about where this is going to be going down. They're going to be moving to Alexandria, Virginia. Now, this is not just a change of address. It is a serious cost savings measure because the cost of maintaining the Weaver building and all the problems that they have are significant. In fact, it is estimated to cost about $22 million each year in just operational and ongoing maintenance costs. So that's a big price tag. Now, this is about creating a culture where they have a more modern work environment, says Secretary Turner, and it reflects HUD's missions and goals. And he says this is a mission-minded shift toward excellence in a new era of service. So why does this matter to us? Well, hopefully if HUD continues to make modernization and improvements in their systems of how they work with the public and their headquarters, hopefully some of that will trickle down to the data that we've been missing for some time from HUD. In fact, we have not had FHA case number assignments since February. We should be up through May at least by now, and we're still just looking at February case number assignments. So we have no real leading indicator to estimate, where HECM endorsements may be in the future. Also, the same goes for the HUD HECM snapshot report. So we hope that HUD will get those matters underway and fixed. And I know that some individuals, including myself, have reached out to HUD asking them to do so. But again, this is the relocation of HUD's headquarters, moving it from Washington, D.C. to a new building in Alexandria, Virginia. And we'll keep you updated if we hear anything else. And it's time once again for our monthly installment of Reverse Market Insights Market Minute with John McCue. And by the way, RMI provides the data that we use to generate the Top 100 Retail HECM Lenders Report. And also they have a great tool that many of our website users are using. That is the neighborhood widget, which allows individuals to just simply do a quick search by zip code and see how many other individuals have gotten a HECM loan. But nonetheless, we got with us, and I don't want to keep them waiting any longer, John McCue with Reverse Market Insight. John, what do you have for us this month?
Hey, thanks, Shannon, for having me back again this month. Really appreciate it. Today, we're going to be talking about what happened in May. And since HUD has not updated case numbers, I thought we could talk about what's been happening with the 10-year CMT to start this segment off. As you can see from this graph, the 10-year CMT really began to start falling at the start of the year. Then we had a flat spell there. And since April, those CMT rates have actually been increasing. Now, in June, they did start coming down again a little bit, but since we're only going to be talking about May numbers, I wanted to kind of cut it off here at the May. And that decrease that we have seen in June was relatively small anyways. But what the big story here is just that rise in the CMT between April and May, and what effects that might have had on endorsements as we begin to look at the May endorsement numbers. So, kind of as expected, we did see a decline. We had but it was modest. 1% from April to 2,296 loans. The regions were mixed. 4 of the 10 were posting increases. The Northwest Alaska remained unchanged. So, again, in February is the last month that we had any case numbers. So it's really hard to tell, if this was the expected outcome, since we don't have those case number assignments to look at. However, as we just looked at the increase in the 10-year CMT, it is probably safe to say that that certainly had something to do with this. But it's still a little early to tell. When we start looking at some of these different regions, Rocky Mountain added 7.7% to 196 loans. The Mid-Atlantic rose 5.8% to 165. And the Southwest Caribbean, it inched up a little bit to 1.2% to 523 loans. As far as the top 10 lenders are concerned here, really similar to the regions. 5 of the 10 were rising. So about half of them, jumped up there. Guild increased 17% to 62 loans. Longbridge was up 16.4% to 390 loans. And Good Life was up 12.5% to 117 loans. So, last month I had also mentioned that the 10-year was rising through May, and that given the modest rise, we should expect a modest decrease in endorsements. So that may have been a contributing factor here, but usually endorsements are a lagging data set. So I don't want to jump the gun too soon, being that, this, with the decrease in May, just because, these numbers are lagging. So, however, we could expect a further decline as we, get into June. However, we could expect a possible, further decline in June when these numbers are come out here. The good news is that, again, from May to June, we did see a modest decrease in the 10-year. So at least that's moving in the right direction for us. The other thing we spoke about last month was home values. We need to keep an eye on the housing market, because if the home values move downward, that too will certainly have an impact on volume going forward. So tune in next month to see what happened in June, and hopefully we'll have further data from HUD by then. Thanks.